Hello everyone, I am Dr. Amandeep Kaur, Faculty, Department of Commerce of Bhopal School of Social Sciences, and today's topic for discussion is insurance. So in this video, we are going to understand the concept of insurance, the principles of insurance and the different types of insurance policies. Now let us start with understanding the meaning of insurance. Now insurance is a means or a contract of protection from financial loss in which, in exchange for a fee, a party agrees to compensate another party in the event of a certain loss, damage or injury. So insurance is actually a contract that is taking place between two parties. First is the insurer and second is the insured. Now the insurer is the insurance company who is assuming the risk of the insured, who is undertaking the risk on the behalf of the insured, and the insured is the policy taker who is actually transferring his risk to the insurance company. Now under insurance, a contract is signed by the insurer and the insured, wherein the insurer promises to pay a specified or ascertainable amount, that is known as compensation, on the happening of a specific event, that is the contingency, in consideration of a premium that is being paid by the insured. Now here one thing is to be understood, that the premiums that are being paid by the insured, that should be regular to keep your insurance policy active and to remain eligible to receive compensation from the insurance company. Now after understanding the meaning of insurance, let us understand why insurance is important, why a person should need to take an insurance policy. Now insurance does not actually reduce the probability of occurrence of a particular event, but it definitely manages your financial loss. It definitely manages the financial impact of a financial loss that is actually taking place. So the insurance is actually very much important for risk management. Another benefit of taking insurance is that it is mandatory under law. Like certain insurances you have to take as per the government regulations, that is the vehicle insurance or the motor vehicle insurance. It is compulsory to take the motor insurance as per Motor Vehicle Act. Now another benefit of taking an insurance policy is that it helps to save your taxes, like the insurance premiums that you pay for your life insurance policy or for your medical or health insurance policy, that is tax deductible under section 80C of the Income Tax Act. So the premiums that you are paying for your insurance policies, it is actually helping you to save your taxes. Now after this, another benefit, one more very important benefit of getting an insurance is that it helps to avail credit facilities. You can mortgage your insurance policy and against your insurance policy you are eligible to get the loans from different banks and financial institutions. So benefit of insurance are huge. It is not only helpful to manage your financial risk, but it also reduces the impact of your financial loss. Then it provides different tax benefits, and also it can be mortgaged to avail different credit facilities. So benefits are numerous for any insurance policy. Now let us understand what are the different principles of insurance. Now in total there are 7 principles of insurance. First is principle of utmost good faith. Second is principle of proximate cause. Then is principle of insurable interest. Next, principle of indemnity, subrogation, contribution, and then last is principle of loss minimization. Now let us understand all these principles one by one. Now the first principle is principle of utmost good faith. As per this principle, both the parties that are entering an insurance contract, that is the insurer and the insured, should act in good faith towards each other. That is, they must provide clear and concise information to each other, and they should not hide any kind of facts from each other. That is, everything whatever is the medical condition of the insured, that should be revealed to the insurance company, and also the insurance companies should reveal all the terms and conditions related to the policy to the insured. So both these parties should act in good faith towards each other. The second principle is principle of insurable interest. Now, as per this principle, the insured or the policy holder should have an insurable interest in the subject matter. Like whosoever's insurance policy is being taken, whether it is a particular person or it is against a particular property or against a particular asset, the policy holder should have an insurable interest in that particular person, or he should have an insurable interest in that particular subject matter or the asset or the property. Now, when the person is being lost, he should feel the pain, or when the particular property or the asset is being destroyed, the insured person should bear the loss of that. So that is the meaning of insurable interest. So the insurance is only taken for those persons, for those assets, for those property in which the insured is having some insurable interest. By the destruction of that particular property, he is going to get some loss. This is the second principle. Now, the third principle is principle of indemnity. Now, first of all, this principle is only applicable for property insurance, and this principle is not applicable for life insurance contract. Now, principle of indemnity. Indemnity means protection against the losses. Now, why this principle is not applicable for the life insurance contract? Because the value of a life cannot be measured in terms of money, in monetary terms. Therefore, it is applicable only for property insurance. Now, indemnity means protection against the loss. So here the principle of indemnity says that the insurance contract will compensate the insured for any kind of damage or loss that is caused only to the extent of the loss that is being incurred, and the insured should not be able to make any kind of profit on the happening of a particular event. For example, a person has taken an goods insurance policy for rupees 10 lakh. Now, right now the goods costing only rupees 2 lakh are being destroyed. So he can claim for a compensation only for rupees 2 lakh. That is he can claim only for the loss that he has received just now. He cannot claim the entire amount of the policy. Remember, the principle of indemnity says that you can't make any kind of profit out of the insurance contract. Whatever is the amount of loss, only that amount will be compensated by the insurance provider. Third principle is principle of proximate cause. Now, under insurance, you are having two types of causes. First is the remote cause and second is the proximate cause. Remote cause is the most distant cause or the far away cause, and proximate cause is the most nearest cause that is leading to the loss. Now, whenever a particular contingency, whenever a particular event is being happening, the insurance company or the insurance provider look out for the most nearest cause, that is the proximate cause. And if that proximate cause is covered in the insurance policy contract, then the insured will be compensated, otherwise not. For example, here a person has taken a medical insurance policy, and this medical insurance policy do not cover the medical expenses for the treatment of any kind of pandemic like COVID. Now, if a person is being hospitalized because of COVID, his medical expenses won't be reimbursed as per the insurance policy, because his reason of getting hospitalized, the proximate cause of getting hospitalized is COVID, and COVID is not covered under the insurance policy. So, whatever is the proximate cause, that proximate cause will be found out by the insurance provider, and if it is there in the if it is being covered, if it is a part of the insurance policy, then only the insured is liable to receive the compensation against that. Next principle is principle of subrogation. Now, subrogation here means surrender of the legal right to receive compensation against the damages in the favor of the insurer. Now, let us understand this principle with the help of an example. Suppose there is Mr. A who gets injured in a road accident due to a reckless driving of a third party, and since Mr. A has taken an accident insurance, so the company has compensated this person against the loss that is being caused to Mr. A. So, the insurance provider, after paying the compensation to Mr. A, can claim the same amount from the third party, as Mr. A has surrendered his right to receive compensation to the insurance provider after receiving the claim, as per the principle of subrogation. Next principle is principle of contribution. Now, this principle is applicable when a person has two or more insurance policies, maybe from the same insurance provider or from different insurance providers. So, as per this principle, the principle of contribution, there should always be equitable distribution of losses among the insurers, or the compensation will be contributed by the insurers in the ratio of the value of the insurance policies. Now, this is very much important. This principle is very important. Now, let us understand this principle with the help of an example. Now, Mr. Kapil has taken two health insurance policies from two different providers, say company A and company B. From both these insurance providers, he has taken a claim of 5 lakh rupees. Now, suppose Mr. Kapil is being hospitalized and there are medical expenses of 2 lakh rupees. Now, Kapil decides to receive the compensation from the company A, and he receives a compensation of rupees 2 lakh from the first insurance provider, that is company A. Now, Mr. Kapil can't claim the same amount from the second insurance provider, that is B. However, company A definitely has the right to claim rupees 1 lakh, that is half of the amount from the company B. This is principle of contribution, that both the insurance providers should contribute together to clear off the claim of the insured. They are eligible to divide the claim among themselves to pay the money to the insured. Next principle is, or the last principle is, principle of mitigation of loss. Now, mitigation means minimization of the loss. Now, as per this principle, it is the duty of the insured to take all the necessary steps to minimize the loss. Yes, it's very, very important that the insured has taken the insurance cover, still he should take all the necessary steps to minimize the loss. For example, if a fire broke down in your factory and you have taken a fire insurance policy, but if a fire has broke down in your factory, still you have to take reasonable steps to put out the fire. You cannot just stand at the back and allow the fire to burn down your factory just because you are eligible to get the compensation. This should not happen. You should take all the measures to put out the fire. So these are all the different principles that are covered under insurance. Now, let us understand what are the different types of insurance policies. Now, basically insurance is of two types. First is life insurance and second is non-life or general insurance. Under life insurance, you are having different type of insurance plans, like you are having term insurance plan, whole life insurance plan, endowment plan, then you are having unit linked insurance plan, that is also known as ULIP popularly. Then you have money back plans, child insurance plans, annuity, pension or retirement plans. Under non-life insurance or under general insurance, you are having health insurance plans, you are having fire insurance plans, then you have travel insurance plans, motor insurance, and finally you have home insurance plan. Now, let us understand all these plans one by one. First of all, let us understand what is the concept of life insurance. Now, insurance as a whole, we have understood that it is a contract that is being taking place between two parties. First is the insured and second is the insurer. Life insurance can be defined as a contract between an insurance policy holder, that is the insured, and an insurance company, that is the insurer, where the insurer promises to pay a sum of money in exchange for a premium upon the death of an insured person to the nominee of the person, or after a set period of time, or after the expiry of the period to the policy holder itself. Remember, this is the life insurance plan, so the person is eligible to get the compensation after a set period of time, the lump sum amount after a set period of time, or in between that period if death happens of that particular person, so the amount will be paid to the nominee of that particular person. Now, the different types of life insurance policy. The first type of life insurance policy is your term insurance plan. Term means period. So, this type of term insurance plan gives life coverage only for a specific period of time, say 10 years, 20 years, 30 years, and after the expiry of the set period, the insurance policy holder has to renew his policy or again has to take an insurance policy. Second is the whole life insurance plan. Whole life insurance plan covers the whole life of an individual. Here the whole life is considered to be 100 years. So, till 100 years the person is eligible to pay off the premiums, and after that he will receive the compensation if he is still alive. So, after 100 years the person himself will be getting the compensation, or in between his nominee will get the compensation. Third type of life insurance plan is the endowment policy or the endowment plan. Now, this endowment plan, this is the mixture of both insurance as well as investment. So, part of the premium goes towards the death benefit, that is part of the premium goes for assuring the life of a particular person, and part of the premium is invested by the insurer in certain low return market securities. Third type of life insurance plan is your money back policy. Under money back policy, the insured is having the option to withdraw certain specific sum of money at regular intervals. Now, these specific sum of money is known as survival benefits. I do not want to get the lump sum money after expiry of the period. I want to withdraw the money after specific intervals of time. So, money back policy gives you that particular option. Next are your pension plans. Pension plans are also known as retirement plans, as they are very much beneficial to do your retirement planning. Under pension plans, again, part of your premiums goes towards assuring your life, and part of the premium goes towards building your retirement corpus, as when you retire you get a lump sum amount together, or you receive monthly payments as annuity. Next type of life insurance plan are your child plans. Child plans are very much beneficial as they provide financial aid for the children of the deceased policy holders. So, here the children receives the money at specific intervals of time. This money may be helpful to finance their educational needs or other life needs like marriage, etc. Next are ULIP plans. ULIP plans are also known as unit linked insurance plans. They are also a type of endowment plans, you can say, in which part of the premium goes towards death benefits and remaining part of the premium is invested into the mutual funds investments, maybe into equity funds, debt funds, or into hybrid securities. So, these are the different type of life insurance policy. First of all, we have discussed term insurance, then whole life insurance, endowment policies, money back policies, pension plans, child plans, and last are the ULIPs or unit linked insurance plans. Now, let us understand what is the meaning of general insurance. Now, general insurance, it offers financial compensation on any loss but other than death. Now, this is the unique feature of general insurance, that everything apart from life insurance, apart from covering loss due to death, all other different types of loss are a part of general insurance. So, general insurance, as it is also a part of an insurance contract, again an agreement is being taking place between the insurance provider, that is the insurance company, and the insured, that is the insurance policy holder. Again here an agreement is taking place between the two parties, that is the insurance policy holder and the insurance company, wherein the insurance company protects your valuable assets from different destructions, from different calamities. It may be natural, it may be man-made, in the form of fire, in the form of theft, or any other unfortunate accident. Now, what are the different types of general insurance policies? Generally, you are having 5 very popular types of general insurance policies. First of all, you are having health insurance policies. Under health insurance policies, your medical expenses or your medical care bills, your cost of hospitalization, your cost of seeking an ambulance, your medical bills, everything is being reimbursed if it is a part of the plan. Next is fire insurance. Fire insurance covers the damages that are being caused to your goods or to your property, specifically due to fire. If the, remember, proximate cause, the nearest possible cause. If the nearest possible cause is not fire but any other element, then the compensation won't be paid. Here specifically, the loss to the goods or loss to the assets must be caused due to fire. Third type of general insurance policy is your travel insurance policy or travel insurance plan. Now, your travel insurance policies compensates all your financial liabilities arising, that is non-medical or medical contingencies during travel within the country or abroad. Now, again, this kind of insurance policy is becoming very much popular because of more and more people, they are traveling across the world. Now, next is your motor insurance policy. Under motor insurance policy, the insured is getting the financial protection to motor vehicles from damages that are being caused due to accidents, fire, theft, natural calamities, etc. And last is home insurance. Home insurance compensate the damages caused to home due to man-made disasters, natural calamities, or any other threat. So, these are the different insurance policies that we have discussed. Thank you so much. In the next video, we will come again with another important topic. Till then, thank you.